Everyone talks about negative gearing as the go-to investment strategy, but is it really worth all the hype? Hi everyone, Kim from GeoTax here. When it comes to investment property strategies, positive gearing is considered a more conservative investment strategy. According to the ATO, around 30% of Australians own an investment property, and within that, 40% of those are neutrally or positively geared. That means that 60% of investment properties are negatively geared. But when things are trendy, it's easy to just hop on the bandwagon without actually thinking about what you're getting yourself into. So it's worth doing your homework and making sure that you consider all investing strategies related to your circumstances and goals. Today's video, I want you to consider whether using the positive gearing strategy could work for you. Property investors always weigh up their options based on tax consequences. So make sure you watch until the end to learn about what you're in for when it comes to paying tax on positively geared properties. Before we get into it, we want to be clear that this video is for informational purposes. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Okay, so what is positive gearing? Well, to put it simply, having a positively geared property means that your rental return is higher than your home loan repayments and other property expenses. So, you're consistently making a profit from your investment property? Let's take a look at a simple example for illustration purposes. Richard purchased his first investment property in Melbourne for $485,000 in a suburb just outside of the city. Because of the prime location, he manages to rent out the apartment for a strong rental return of $575 per week. Assuming that the property expenses he incurs amounts to $460 per week, Richard can cover the expenses with a rental return and have a surplus of $115 per week. So this means that Richard's property is positively geared. Having a positively geared property means that you're likely to continue generating a steady income stream while you wait to realize the property's long-term growth, especially if you buy the property in an area with high rental demand and strong rental returns. Another advantage of having your property positively geared is that it'll pay for itself. As you saw in Richard's example, his rental income covered the expenses incurred for owning the property. This means that he doesn't need to use part of his wages to cover the home loan repayments. Having a positive cash flow means less pressure if your financial circumstances happen to change. Lastly, if your investment property is generating enough income to cover your expenses and more, the positive cash flow can help you grow your income, meaning that it could be easier to secure another home loan to expand your property portfolio. When it comes to paying tax on your positively geared investment property, just like the income you receive from your wages, the income you generate from your investment is subject to tax. Investors love the idea of negative gearing because they just want to focus on reducing their tax liability. But if you had to compare reducing your tax liability and actually making a profit on your property, making a profit is a good thing. It shouldn't be considered a bad thing just because it comes with slightly more tax liability. That's not to say you should stop finding ways to reduce your tax liability. It just shouldn't be the deciding factor for choosing an investment strategy. So even though you'll naturally have to pay some tax on positively geared property, there are still some beneficial tax deductions that you can claim to reduce your taxable income. The top 3 tax deductions most people claim are: number 1, depreciation, which allows you to claim a deduction for your building's general wear and tear and its assets. Number 2, interest on your loan. This is the most significant tax deduction you can claim. And number 3, rental expenses. As a landlord, you'll have to pay a whole bunch of different expenses such as advertising, cleaning, and quantity surveyors fees. Just like any investment strategy, it's also important that you take into account some of the possible risks of using it in relation to your current financial circumstances and future goals. When it comes to finding properties with the potential to be positively geared, it's a lot harder than it sounds. Negatively geared properties are so much easier to find in Australia. Higher demand means higher prices and lower rental yields. The lower the rental yield, the harder it is to have your property produce a positive cash flow. But it's important to realize that while positively geared properties are harder to find, they aren't impossible to find. These properties do exist. You just need the right team in your corner to help you find these properties. If you need help with this, check out our video on the 4 property professionals you need on your side. The next factor you should consider is that you'll likely end up paying higher upfront capital. Not only are these properties generally higher in price, but by paying more upfront, you're decreasing the amount of money you have to borrow from the bank. Smaller mortgage repayments will make it easier to generate a profit from your rental income. At the end of the day, it all comes down to planning and keeping up to date with economic and property market fluctuations. That's why we emphasize on building a team of property professionals to help you navigate through making the right decisions for you and your circumstances. I hope you've learned some valuable information about positive gearing. If you have any questions, please leave them in the comments below. We would be happy to help. Alternatively, make sure you like and subscribe to learn more property investing tips. I'm Kim Quach from GeoTax. See you next time.